Okay, hi everyone. Very good morning to all of you. Thanks for joining us this morning for the final day of our Quantitative Investing Festival. Right, throughout the past 3 weeks, we have covered a lot of ground, and no matter whether you've been with us for just one session, a few sessions, or all of the sessions, we genuinely hope that we have helped you bring in that increased exposure and increased knowledge about quantitative investing. For those of us who might not know me yet, right, I'm Dawei from iFAST Global Markets. I'm running investment advisory and providing wealth management solutions to clients using the iFAST investment platform. And I'm also one of the organizers for this Quant Investing Festival. Today we have with us again, of course, our education partners and co-organizers from AllQuant, like Mr. Eng Guan and Mr. Patrick Ling, who will be participating in our discussion topic today on how we can invest $100,000, right? Eng Guan and Patrick, you guys want to come on and say hi and maybe give just a brief introduction about yourselves again?
Yeah, sure. Thank you, Dawi. Okay, hello everyone. I think AllQuant have been here for like 7 out of the 10 sessions. So I think some of you who are attending this not for the first time, you have heard me spoke or introduce myself many times. So apologies for that. Okay, but for those who do not know me, my name is Eng Guan. Okay, I'm one of the co-founder as well as the partner of AllQuant together with Patrick. So AllQuant again, right, is a specialist kind of education firm that kind of teaches retail people how to invest using quantitative approaches. Okay, and we also work with like various industry partners, including iFAST Global Markets, to see how we can reach out and promote quantitative investing to more people. All right, and a little bit about my other background before starting AllQuant. I have like spent before starting AllQuant around 15 years of my career, right, throughout the asset management, banking, and hedge fund industry. I first started off in GIC, which is a sovereign wealth fund. So over there, I kind of work like a hedge fund investment analyst, where I kind of conduct investment due diligence on hedge funds. So I speak to a lot of hedge fund managers back over there and see how they invest and what type of strategies that they do. And after that, I moved on into investment banks, Barclays and Credit Suisse, but I did something a little different there. Over there, I focus more on valuation control matters, looking at structured products, valuation issues, and the types of deals that the banks actually takes or trades with the institutional clients. Then I moved on to prop trading for a couple of years, where I traded interest rate futures spreads and all types of short-term trading stuff, before eventually moving on to join a hedge fund called Liquid Value Asset Management. And over there, I was focused on running a multi-strategy hedge fund together with Patrick. And the principles that we adopted at the hedge fund, right, is the same that we kind of use today at AllQuant itself. Okay, so that's in a nutshell my background. Okay, back to you, Dawi. Dawi, you're muted. Yeah.
Let's move to Patrick.
Yep. Hello, everyone. Yeah, like Eng Guan said, right, this is probably the 7th time that I'm introducing myself, but do bear with me. This will be the last time. So my name is Patrick, and I'm the other co-founder of AllQuant. So before starting AllQuant, right, I've spent more than 15 years in the industry, starting out as a portfolio manager in UBS Private Bank, where I helped to implement discretionary portfolio mandates for private clients. Then after a couple of years there, I moved over to Hong Kong to work for an investment bank, covering hedge funds and institutional clients who wanted to trade equity derivative products like options and swaps. Then ultimately, I came back to Singapore to join Credit Suisse Product Control Department. So my role there was to review rates and FX structured products that's traded by the bank. And finally, I ended up running money in prop trading. And eventually, I became one of the portfolio managers in a quantitative hedge fund, implementing a multi-strategy portfolio together with Eng Guan. All right, so that's just a quick summary of my professional background. Okay, back to you, Dawi.
Thanks, Patrick. I believe many of us would be somewhat familiar with you guys, or very familiar with you guys by now, especially if they have been joining us since the very first session 3 weeks ago on the 11th of September. Okay. And so for today, as the finale day, right, we are going to use the time to answer the big question on hand, right? How can we invest 1,000, right? And I'm sure that everyone here, the fact that you're joining us today on this beautiful Saturday morning, it goes to show that all of us, right, to some extent, will want to be able to obtain some answers as to how we should be investing our monies, right? But the truth of the matter at the same time is also that this question by itself can still be a very, very broad question, right? Not only can it be answered in so many possible ways, depending on what answers we obtain for this question, it may or may not leave us better off for the long run. Right? Many a times when we ask this question, right, when we ask a question on what should I invest my money in, right? And we hear that, hey, you know, this basket of ETFs is good, right? These stocks are attractive, right? These commodities, they're good. Right? It can be so easy for us at times to get caught up in zooming in to these one or two possibly good investments. And while we may very well put our money into them, invest in them, and even reap some very good returns over the first few years, right? But at the end of the day, for the questions that we ask, right, for the answers that we get, the investment experiences that we all go through, are they making us a little bit wiser every step of the way? Are we growing to be more financially savvy, a little more financially prudent, a little more experienced in knowing how to take intelligent risk, right? And from there, right, more ready even to help guide some of our loved ones, our family, and our friends in stewarding our wealth and blessings in a meaningful manner, right? Are we moving towards that? And such is the spirit in which myself and all the other co-organizers for this festival from both iFAST Global Markets and AllQuant, we would like everyone to have when we go about answering this question today. So in going through our topic today, we are going to do a few things, right, to answer this question. Right? First, we are going to invite our experts, Eng Guan and Patrick, right, to share with us how their view of how retail investors should invest, right, has changed over time. Right? Starting from when they first began investing as a young person, right, over to when they went into asset management and portfolio management, and then eventually into running hedge funds. Right? So we are going to hear their very interesting stories and shifts in mindsets over the years throughout their professional journey. Okay. After that, we are going to do a quick recap on all the lessons that we have learned so far in this festival spanning 3 weeks. And the aim is to use this summarized bird's eye view of things, right, of insights that we gain throughout the festival to talk about how they are applied in running the model multi-strategy portfolio that AllQuant has been encouraging their students, their clients to run, right? And following which we are going into the second half of our Quant Investing Festival Students Challenge, where last week we had students from Nanyang Technological University sharing their work, right? And this week, today, we are going to have our students from the Singapore University of Social Sciences Investment Group to come and share with us their fruits and labor after learning from their mentors in AllQuant on how to integrate quant investing procedures into their own investments. Right? And of course, at the very end of today's session, before we conclude the festival, we are going to announce the winners for our festival lucky draw. Right? So for those of us, right, who have been attending our sessions and getting correct answers for your festival quizzes, right, the chances of you winning the lucky draw has gone higher and higher. Right? And today's the day where you find out whether you will be winning one of AllQuant's mega, intermediate, and starter course packages and walking away with CapitaLand vouchers or our very cute iFAST soft toy plushie. Okay, so without further ado, right, let's begin to hear from AllQuant, their own personal experiences in retail investing. Right, let's start with Eng Guan first. Right, Eng Guan, could you share with us individually how you first thought about, right, investing as a young person, right, and what are some of the lessons you learned along the way, as well as any shifts or growth in your mindset towards investing as you proceeded along in your career in the investment industry?
Okay, yeah, okay, thank you, Tawi. Okay, now when Tawi first posed this question to me, I was thinking, oh my goodness, I'm going to cover that. Where am I going to even really kind of start off with? Okay, so what I'm going to do is talk about this. Okay, everyone actually starts at the same point. Okay, I'm no different. When I first started out, I'm a retail investor. Okay, and the only thing I know is stocks. All right. So what happened is that I just go open a brokerage account, Lim & Tan Securities. All right. So for those in Singapore, you know which broker that is. Okay, I go and open up an account with a friend. So that was 20 over years ago when I was still in my university days. And then I start plunging into the platform and then look at the stocks and load up the counters and see all the numbers flickering around. So that was when I first started. Okay, and when I first started, my mind is a blank sheet of paper. Okay, I didn't even do any homework or do any detailed research into stocks. So all I see is that my friends are investing and they are making money, because that was back in the 90s where you have the dot-com boom going on and you just basically throw a dart at any counter and then you can make money, right? So to me, that seems like easy money to be made, no? So I open up, I look at the counters and I try to kind of pick counters that kind of look like tech sounding names. Then all I did was I look at the prices. And back then, I also have no concept of what valuation is. To me, prices are just prices. I see a stock at 50 cents, another at $5. To me, the 50 cents is the more, it's the cheaper one or the more affordable one to me. Okay. So as a student, I don't have much money. So naturally, I go and pick those penny little stocks. And I go and dump a couple of $1,000s into one of those counters. Okay. And happily think that I'm going to make money right after that. Okay. But as it turns out, no. That counter which I picked keep losing money, keep losing value over time. Okay. To the extent that one day, wow, it suddenly just vanished off from my platform. No, vanish, no, it disappears. So you go inside your platform, load your portfolio, and the counter is no longer there. Now imagine the shock that I have. Okay. So I went to call up the broker that on the day itself, and I asked him, no, what's wrong with this? No, is there something wrong with the platform? I don't see my counter anymore. Okay. And I get scooped that day, all right? And he told me what I bought is not a stock, but a warrant. Okay, so if you guys don't know what a warrant is, basically a warrant is just like an option, except it's issued by a company. Okay, and if you have no idea what it is, then you're exactly the same as me back when I was like 20 over years ago. I absolutely also have no idea what I just bought was a warrant. So what happens is that warrant have an expiry date. So basically, I hold on to the warrant until it disappears from my portfolio itself. Basically, the value just keeps drop until it expires. Value is zero. Okay, so that's my very first trade. So sometimes when I look back and see my very first trade or how I proceeded on to invest, I'm quite amazed now why I even do that. Basically, I never do any homework. That's how I was back in 20 over years ago when I first started. Okay, but I didn't give up after that. I mean, after that, I still tried on with other different things. Then I decided to go long-term and I tried a fundamentals approach. I started to read annual reports, analyst recommendations, and I started to pick a few counters. Okay. And I intend to hold them for the long term. So I bought them. Then what happened? The dot-com crash came in the year 2000. All right. And despite my original premise was to hold it for the long term, when I see the stock falling 10%, 20%, 30% and more, no, I cannot take the pressure. It was immense. It's just a few $1,000s, but back then I was a student. It was a lot for me. Man, I got to do a lot of work, tuition, and all just to earn that few $1,000s back then. Okay, and eventually I bailed out and just liquidated everything. Okay, so it didn't work for me as well. No, I cannot control my emotions. I didn't do it well. Then I tried to look at technicals and try to do a little bit of short-term trading using technicals. Because if I want to kind of navigate, or I think I could navigate the markets, right? Better if I look at short-term. Maybe I can avoid a crash altogether, right? By liquidating early or what. And again, didn't really work out for me. And I go even shorter term. I started to do intraday trading, trying to pick a few cents here and there. Okay, and it can be a bit addictive when you win because intraday, it's quite easy for you to kind of make money here and there, very small little bit of business. But just one big market move is going to kind of like wipe all you make, right, in just one single trade. And so one single losing trade can really wipe off like 10 or more of your winning trades. So again, the payoff wasn't right, and intraday also doesn't work for me, right? So really the big truth for me, right, came only years later, right, in 2006 when I first joined the asset management industry. Okay, so it was there when I was kind of introduced to a whole landscape, right, of things beyond just stocks. Okay, and the very first takeaway, right, when I joined the asset management industry is to learn about the importance of using different asset classes. Okay, because in my line of job back then, right, I can get the chance to learn from different managers, both internal within the company itself. I also talked to a lot of external hedge fund managers who are doing all sorts of different strategies across different asset classes. And at the same time, because you're full-time into it, or I'm full-time into it, so I can kind of observe and look at how the market changes and everything like starts to fall into place. All right, how the markets behave, how the different asset classes react, and all those. And all this become very important pieces of information that kind of shape how I invest later on. And it's very interesting, you know, take for example, the great financial crisis. Okay, so different asset managers who will concentrate on different things will pick up different things and focus on different things. Okay, and most of you are more likely familiar with stocks, and you think that the stock market kind of move first and detect everything first, in almost all the things that's to come, right? And everything and everybody else is maybe later, right? Will realize it later. But that's not the case in the great financial crisis. No, in fact, when I talk to the equity managers before the great financial crisis come along, a lot of equity managers are still kind of happily going about, like picking stocks, doing valuations, and kind of structuring their portfolio in the same way. Some of them are totally oblivious to the risk that is coming up next. Some of them are aware of potential risks that are brewing, but they are not really factoring them into their portfolio as of yet, right? So these are the equity or the stock managers. But if you would talk to the fixed income managers back then, it is entirely different story. The fixed income managers were already kind of warning about the stress and cracks, right, that they were seeing within the loan markets, right, especially in the subprime and the leverage loan space. Okay, so these guys, right, already talking about impending problems coming up, and some were kind of watching, also like watching the adjustable mortgages, right? And anticipating potential widespread defaults that can come. And that was as early as the middle of 2007. Okay, the crash has not begun yet. Okay, and a few months later in October 2007, the crash begins. Okay, back then I was just a very junior analyst back in the asset management industry. So I'm really impressed by that. And so I learned a very important lesson here. Don't look and focus just at a single asset class. No, the world is wide. If you focus only just on a single asset class, you're going to miss out on a lot of things out there. Okay, so that is the first key thing or takeaway for me when I joined the asset management industry. Then the second thing, right, that came into my life and kind of shaped and changes how I do things, right, is I picked up quantitative investing, right, also within my job. So before I pick it up, right, all I was doing was trying to read reports, read analyst recommendations that are issued by the investment banks, then maybe plow through some economic data and look at charts to kind of get a sense of where the market is and try to formulate a view and predict like what the market is going to go next, right? But I have no way, right, of kind of verifying whether my thinking is going to be right or wrong, because this was at this point in time the data I have and what I think or make sense of it, right? So after I pick up quantitative investing, right, I learned that instead of trying to do that, right, I can just simply build models, right, and then backtest my ideas, and then I can find my answers inside there. So with backtesting and modeling and all the technology in place, you now have the power of like science, math, technology all behind you. So why not make full use of it, right? Because you can find a lot of insights and answers you want inside all this modeling itself. So besides this, it has the, of course, when you model, you have a precise rules and set of strategy in place, and that kind of helps you deal with emotions and all that, right? Which for me particularly, it was a problem when I first started out. Okay, so besides that, right, the quant approach, I can also kind of look at and manage different asset class, different securities, different strategies all at once, right, without kind of like overly straining my resource. Okay, but if I were to kind of do it from a qualitative or discretionary approach, right, then I cannot manage everything single-handedly, right? I'm most likely going to need like analysts below me or traders working for me to help me out with all the work. But with the quant approach, I can do all that, right? So it helps a lot in terms of kind of like managing your time and allowing you to kind of do a much more broader approach, right, to tackle the market itself. So that's the second takeaway, the power of quantitative investing that we can actually leverage on to help us in investing. Okay, then the third thing, right, is I learned, right, and subsequently also later on, is that you actually don't need a market view to invest or trade. Okay, so for all of you who have attended all the previous webinars, have you ever heard me talk about market views? I don't think so, right? Because I rarely talk about market views. And some of you are going to find it very baffling or strange. Okay, if I was 20 years ago and I saw someone presenting and ever talk about market views, I probably have the same thoughts as well. Okay, but if you do understand like what I'm doing today, right, then you will know that I actually don't need a market view to invest, because what I'm relying on are actually my models, right, which are running specific strategies that are based on good fundamental premises, and then every one of them are backed by probability and statistics, which are really thoroughly researched and tested, right? And a lot of quants will take this approach. And I can tell you it's also not the quants that take such an approach. Even discretionary investors, right, also sometimes have the same view. All right. And it was actually one of my early mentors who was a discretionary trader who kind of like drummed that inside me. Right. So so basically this early mentor of mine is he's a hedge fund manager back then, was managing fund of like over $1 billion. And there was one session where I had with him, right, closed door within the room itself, where he was asking me, Eng Guan, what do you think is the most important thing, right, in order for you to succeed in trading? So straight away, I rattled off. Back then, I was still very junior and I don't understand a lot of things. I told him that, okay, you basically got to be very analytical. You got to kind of make use of the data to come up with the right market view. And you guess what his response is? Okay, so basically his response is something quite shocking to me back at the time. Basically, he showed me a finger, like which finger? I'm not gonna tell you here. It's between men, all right? So that universal finger that everybody gives, right, when they are quite pissed off. But he wasn't pissed off. He was just trying to get a point across back then. So what he told me that, no, your market view don't matter a single bit to the market. No, not yours, not his, not everyone else, right? Because the market don't care what you're thinking, right? That's for one. And the second thing is, no, it is not your view, right, alone that is going to be shaping your investment itself. More important is your skill, right? For him, he's a discretionary trader, so he focused a lot on skills. But it is what you do when you're right. Okay, so your market view may turn out to be right and may turn out to be wrong. But if it is right, no, it takes time to pan out. And how the market is going to react and move in between determines what you're going to do before the views even pan out, right? Are you going to take profit? Are you going to have stop loss? Are you going to kind of put in more trades? Are you going to size it down? No. So what are you going to do, right, in between that view and the point at which you put on the trade? That determines like how much profit you get to make even when your view is right. Okay, the same thing applies, let's say, when the view is wrong. Okay, when your view is wrong, then what are you going to do, right? It's not so much your view is wrong. People get views right and wrong all the time. So when it is wrong, again, it is what you do in between and how you manage risk of the trade all the way to the time with the power. That is the important part, because it determines at the end of the day how much you are going to lose, right? And a good trader can actually minimize your losses, or to some extent, you may turn out flat. And this particular mentor that I kind of like had the opportunity and the privilege to be mentored under actually sometimes even managed to make off with a little profit, even when his view is wrong. Okay, so it takes some time to digest, right, when he told me all this. But eventually, over time, as you get involved with the market, you try to keep on applying what you do and learn, and things starts to materialize and ties in together. All right, so as with all types of things that you do, right, investing actually is no difference. Okay, knowledge and theory is only the first part, and that kind of gives you some of the basic criteria in order for you to succeed. But at the end of the day, right, you got to really kind of apply it through, right? So that's the part where experience comes in. So I can give you a model, but you don't follow it to the dot, there's no use as well, right? So you can only follow a model to the dot when you have a deeper understanding of how the market works, by being in it, right, experiencing for yourself and applying yourself diligently every single day, right? And with that, then you will come that necessary confidence, right, after you actually internalize all the knowledge and theory that you've learned over time. Okay, so for me, that's the 3 key takeaways that kind of shaped how I invest differently from when I first started. The first one is approaching different asset classes and not just looking at a single thing. Or the second thing is to apply the quantitative approach towards investing, because everything then is based on empirical evidence, statistics, and probability. And the third one, what is a bit more philosophical, right, but also very important, is that You need to recognize that you actually don't need a view to trade. Or if you have a view, the view is not your most important thing, right? It is your plan and strategy, your overall plan and strategy. What you do when you're right, what you do when you're wrong. So that determines at the end of the day how successful you can be. Okay, so that's in a nutshell what I want to share for this particular part. Yeah, back to you, Dawi.
Thanks, Eng Guan, for your wonderful sharing, and a really very interesting story, and really great to know how you have experienced investing over time, starting from when you were young until today. Right. And I'm sure that was very helpful and very maybe even enlightening to some of us, especially some of the younger guys, like the newer investors today. Okay. For now, let's move on to Patrick. Right, Patrick, would you like to come in and share your experience as well?
Yeah, sure. Thanks, Dawi. Before that, I'll just like to apologize because there's some renovation going on above me, so you might hear some interrupting noises coming through. It's also affecting me, so do bear with me if I take a break sometimes. So everybody have their own investing journey. I'm no different. So, but the important thing is what do we learn along the way, and the question is whether do we learn the right lessons or not. And so that really determines whether somebody, right, after going through the journey, turns into a successful investor, or they continue to make the same errors and mistakes over and over again. So the important question is whether are they learning the necessary lessons from all the events that happen throughout their own investing journey. So maybe let me just share my own journey. So I think I can broadly break it down into two phases. The first one is discretionary, when I was still a discretionary investor. And the second one is when I turned into a quantitative investor. So I started my journey right back in 2001. So I think market was very kind to me because it threw my way a black swan event, which is basically the 9/11, the terrorist attack on the Twin Towers. So back then, right, I guess like everybody starting out, I didn't really have a plan. So all I knew was basically just load my portfolio with stocks with names that I think probably will do well. So I just go ahead and do stock picking and all that. And of course, like every starting out investor, right, my thinking back then was the same, basically to go for all the penny stocks, because thinking that penny stocks are cheap and therefore they have more room to rise going forward. Okay, so anyway, the story is that on the day that the September 11 attack happened, right, my portfolio was loaded up with stocks. So you can imagine my surprise when I saw that thing happen on TV right before my eyes. And I thought it was a Hollywood movie. I thought, what is this new Hollywood movie that's coming to us soon? But then I soon realized that this is not a movie. This is happening in real life. So that's when I realized that my portfolio is likely going to be hit very badly. And indeed it was. So the next day, right, when the market opened, my entire portfolio tanked by 10%, right? And that is on the entire portfolio. If it's just on one single stock, right, you can probably kind of expect that this kind of thing can happen. But when it happened to an entire portfolio, that's entirely another different thing altogether, right? So anyway, my portfolio took a big hit. Obviously, it affected me, and then it proceeded to drop a bit more over the next coming days. But of course, fortunately for me, I didn't panic sell, so I held on, and obviously, eventually, my portfolio recovered. So, but that event, right, taught me, or rather introduced me to this existence of black swans, which means to say that, very often times we like to tell ourselves, right, oh, this thing cannot happen, or this is impossible, it will never happen. But that event tells me that don't ever say that kind of thing, because anything, and literally anything can happen in this world, all right? So knowing that, right, then you probably think about, are you positioning your portfolio the right way, such that even if a black swan event happens, right, your portfolio will not be hit that badly. So that's the first lesson that I learned, okay? Now, the next lesson happened in 2003. That was during the SARS crisis. Of course, today, what we're going through, right, probably pales the event back then. But, back in 2003, when SARS happened, right, it was a totally new thing to me. So, for the first time, I didn't know what's happening. I just know that, oh, this is a very deadly disease that anybody can just die from it. So, but on the portfolio level, right, what I witnessed was that even though I had so-called fundamentally sound names in my portfolio, but every day without fail, my positions will continue to bleed day after day. Okay, so I can only just sit there and watch my portfolio sink every single day, and I could do nothing about it. Okay, so that got me thinking, right? So why is it that, fundamentally sound names, and these companies are still making profit, but why is it that day after day, these companies are still losing their in terms of their stock prices? So that taught me another lesson, and that is the macro environment, right, actually takes precedence over your micro events. Meaning to say that all your companies, right, no matter how strong they are, if a significant macro event comes along, then you can expect that all your fundamental analysis, you can just throw it out the window, because the macro event, right, will basically supersede all this micro level stuff. So all your positions in your portfolio, right, they will also succumb to the influence of this macro event. Okay, so basically macro wins. That's the lesson that I took away from there. And then the next thing that happened to me, right, was in 2005. Okay, back then I was still basically having a lot of stocks on my portfolio, and these are positions that were doing well because basically then, right, the bull market was in full swing. So the market was rising, and therefore my portfolio was also rising along with it. So, but then back in 2005, right, then it got me thinking, right, that market seems to be getting a bit expensive. Okay, so I took the discretionary decision, right, to basically just close out every position in my portfolio and just set in cash. Okay, because back then my very, very naive thinking was that, oh, I can just time the market. I think that the market is expensive, it's going to come down, and when it comes down, I'm going to go back in again. But that was a mistake that I made, because I can only sit back, right, and watch as the market continues to move higher and higher and higher all the way into 2007. Okay, so the lesson that I took away from here is that you can be too early, and the mistake, or rather the impact of being too early, right, is also almost as great as if you were late, right? So if you are too early, what happens is that you basically miss out on the the subsequent market move, right? And then you end up being too afraid to even enter the market again, because then you'll be thinking, I already missed the boat. What if I go in now, right, and then the market really, as what I foresee, right, tanks, and I'm going to kick myself and say, hey, why did I do that, right? But the fact is, nobody can predict what the market is going to do. All right, if anybody can tell you that I can successfully pick the tops and bottoms, right, then I think you really got to question that, right? So that's the third lesson that I learned. And of course, the fourth lesson was during the Great Financial Crisis. So during this time, right, it coincided with my time working with the investment bank. So in the investment bank, I was in a very privileged position where, through my dealings with the hedge funds and the institutional investors out there, right, I happened to basically be very, very aware of what's going on with the subprime crisis in the US. So back then, I had a very strong gut feel inside of me, right, that tells me that something serious is going to happen. And therefore, I proceeded to put on a synthetic short position in my portfolio. And basically, this is the only first time that I re-entered the market after sitting out from 2005. So from 2005 to 2000, actually it was the end of 2007, I basically did nothing, right, just watching the market. And then towards the end of 2007, that was when I re-entered the market to position myself for the crisis that I think was going to come next. Okay, so I did a synthetic short position on the S&P. So basically what I did was I basically bought put options, and then on the other hand, I sold call options. So it's like a synthetic short position on the S&P. So as it turns out, right, I mean, I was right, and I started to see profits in my position. But the thing is, I committed the next error, which was not knowing what is my exit strategy even before I entered the position. So even though I was right in my positioning, right, I picked the right position. But because I didn't have any exit strategy in place, I started to kind of like let my emotions go along with the market, right? It became like a roller coaster ride. So I didn't know what was the next step that I should do. Should I hold on to my shorts, or should I close them out? So basically that period, right, because it was very volatile, my mood was also very volatile as well. So I became very stressed, even though my positions were in a profit, sitting on profits, but I was very stressed because I didn't know what was the next move to make. And in fact, my P&L was swinging wildly, right, from making a lot of profit to cutting back on my profits and so on and so forth, until I remember very clearly, right, the day that the US announced the TARP plan. which is basically they decided to pump in a lot of money to bail out all the banks and financial institutions. That was when I said enough, I couldn't take it anymore. So I basically closed out my positions. And then subsequently after that, I even put on a little bit of long in my portfolio as well. But then the story didn't end there, right? Because after the TARP plan was announced, the market continued to tank even all the way until March of 2009. Okay, so I basically from that experience, I told myself that following this approach of discretionary trading, right, it's not for me, because even though you might be right in picking some of your trades, it doesn't give you a game plan, right, of what you're going to do next and what really should be your next move. And that to me, kind of like, it's a bit like gambling, right? Because it's like, placing bets on the roulette table and say, oh, I'm going to bet on this number. And if you're lucky, you just get hit and then you get your profits. If you're wrong, you lose your money. So to me, it wasn't a very sustainable approach. And then I also thought to myself that how many of such events is going to come along during my investing career? Will a great financial crisis happen every year? No, right? Most likely it's not going to happen again. So even though I made money from this event, it is not going to be a sustainable way of making money going forward. So I started thinking that, is there a better way to do it such that, my investing can be more, I guess, more sustainable and based on a more sound plan. So that's why I started thinking about this this project that I did when I was doing my master's studies in school. So I did a master's in wealth management, right? So during the program itself, we're all supposed to do a final year project. It can be on any topic. So what I chose back then was I basically looked into a risk management approach of investing in equities. So the idea is actually very simple, right? So instead of just buying and holding stocks forever and ever, right? Why don't we put in place some kind of risk management methodology such that we try and avoid hits during bear markets. So when markets come down, right, you try and get out of the market and then only go back in again when the conditions are right. So this thesis that I did, right, turned out to be a workable model. I tested it across a lot of markets, from the US to other developed markets to even emerging markets. And the conclusion that I drew from there is that a risk management approach, right, to investing in equities is definitely better than just buying and holding stocks, forever and ever. So now that with that in mind, right, I started to develop my own first quantitative model, and that turned out to be my trend following model. Okay, so I started to implement my investing using a trend following model, but that is where the market started to teach me my next lesson. Okay, because after 2008, right, in fact, 2008, trend following models make a lot of money. So there were the other strategies, or one of the rare strategies in 2008 that actually made a lot of money. Okay, but after 2008, what happened was that the market started to go into a period of crisis after crisis. Okay, then we have, after the great financial crisis, then Europe started to enter their own crisis, the Eurozone crisis and all that. So market was basically lurching from bull to retracement, bull, retracement, So because of that, right, the trend following model actually didn't really work that well because it actually suffered from a lot of whipsaws. And this was a very prolonged state from 2009 all the way to 2013. So that taught me a very interesting lesson, and that is no single strategy works in all kinds of market conditions. Okay, in fact, the strategies why they work is not because they work by themselves. It's because of the market state that they are applying the strategies on. So let me give you a very easy example. Okay, so for a simple traditional long only strategy, right, they always like to brag that, oh, they made a lot of money during the bull market. But that is only sensible, right? Because in the bull market, all stocks that you buy also goes up. So any long strategy that you employ, right, will definitely make money. But it's only when the bull market comes along that you realize that all these strategies actually doesn't work in that kind of market state. So likewise for trend following, right? Why does trend following work? Trend following work only if you are in a market state where the market continues to move in the same direction for a sustained period of time. So that is where trend following works. But once the market moves into a mean reversion state, right, where market keeps moving within a narrow range, trend following is never going to work. Right. So with that, right, with that lesson, then I move on to think about what other strategies can I add to my portfolio that can actually make up for the weakness of trend following. So that's where I developed other strategies like risk parity and volatility strategy. So these are strategies with their own return drivers, and they work under these different kind of market environments as well. So I put it in together as a blend to my trend following model. And luckily, I didn't dump my trend following model, because shortly after 2013, right, it was a blowout year for trend following. My trend following model actually made about 40%. Okay, but by that time, I was already running a multi-strategy. So my other strategies also come into play. So, but the point here is that if you want a kind of like a smoother return journey, right, you cannot just rely on any single strategy, right? You need to have a diversified blend of strategies that works under different market states, so that when one strategy is not working for you, right, other strategies that are doing well in the particular market state can take over and still generate that profits for your portfolio. So with that, right, I mean, basically I've developed to who I am today, and I've never looked back since then. And right now, right, if you ask me, if I were given 100K 20 years ago, would I know what to do with it immediately? My answer is no. Because first of all, I'll be asking myself, 100K, what am I going to do with it? Where am I going to buy? What stocks am I going to buy? Is it even the right time to buy the stocks? Is it the right market condition for me to start investing? So all these questions will be kind of like hindering me from investing the 100K. But today, if you give me 100K, right, I know straight away what I'm going to do with it, because I'll just simply deploy the full 100K into my various multiple strategies in my portfolio and just let it run. Because it doesn't really matter what market state that we are in today. There'll definitely be some strategies, right, that's going to work in this market state. So, and also in terms of emotion-wise, right, you cannot prevent your emotions from still moving along with the market, because every day the markets will show a P&L on your portfolio. So that one cannot be avoided. But what is avoided is that now I can stop second guessing the market. I can stop second guessing the market, thinking that, oh, is this market going to do this? Is this market going to do that? I don't have to bother with that anymore. All I need to know is I look at my models. Are they still performing according to what I expect it to do, given the current market that we are in? Or is it deviating? If it's not doing anything strange, I don't have to worry. I just continue to let it run. Okay, so I think it has definitely grounded me as an investor, and it has helped me to maintain my emotional level more stable throughout whatever events that comes my way. And in fact, it's very interesting because ever since I started the quantitative investing approach, right, there are a lot of events that happen. We have the, back in 2016, we had the Trump election, right? And then we had February 18, 2018, where we had the apocalypse, where volatility just spiked 100% up. And of course, we have the COVID-19 crisis. So a lot of crises still came along, and of course, it impacted markets and all that. But I observed the difference it made in my portfolio, because it's definitely much more stable compared to if I was still running on the discretionary approach. Okay, I think that's all for my sharing now.
Thanks, Patrick, for your sharing. Right, certainly great to be able to hear from you how your thoughts have changed over time, and so many lessons learned as well. Right, definitely both Eng Guan and Patrick, given your track record and experience, right, that growth and maturity process for each of you guys personally as investors, they are definitely helpful. Right, a lot to learn, and I'm sure that a lot of us we benefited from hearing from you guys today. Okay. And also to proceed on, right, let's really come and learn from all that we've gathered this festival, right? So that every one of us, right, let's not walk away with just an idea of, okay, this is just one possible way to invest, right? But rather let's walk away with more knowledge, right? And more importantly, more wisdom, right? To know that, okay, this is how I want to, and I should be managing and accumulating my wealth over time. Okay. So let's take a quick look at what we've covered these last 3 weeks. Right? On the first day, we talked about hedge funds, right? On how the world's most successful funds are hedge funds, right? With the famous example being the Renaissance Medallion hedge fund, right? That has almost 70% return per annum since the year 1988. Right? And while these hedge funds, they are commonly exclusive to private networks, right? The high net worth, and usually the large financial institutions. There are still a lot of things that as retail investors we can learn from these hedge funds. Right? The most basic of which is risk management. In the retail investing world, many of us, we are exposed to using conventional 60-40 or 80-20 portfolios, from which we can rebalance, say, every quarter or every year. And this is actually what most robo-advisors out there we see today are doing. And while this is perfectly workable and can definitely bring us some of those returns that we are looking for, what the 60-40, 80-20 portfolio does also is that although it balances out our asset classes, it still doesn't focus so much on balancing out our risk. And what this can lead to is higher volatility in our portfolios, higher risk, which may very well not compensate us that much by returning our return potential. So what we learned on that first day was that we should be adjusting consistently, not so much the asset allocations of our portfolio, but rather the risk allocations of our portfolio. And on the second day, we talked about the quantitative approach. Because of how powerful computers are today, it is possible to account for a very large number of considerations for our investments while keeping everything clearly based on foundational logical basis of reasoning. And part of the quant approach is also its philosophy, of having all decisions justified through logical analysis, instead of the usual investment approach, which often may involve emotional instinct, in one way or another. So now we know, that hey, there is a way to arrive at the decisions needed for our investments to be successful, without letting instinct come too much into play. And if that's the case, shouldn't we give this form of investing some very serious consideration? Then we covered on profiting in clarity, which in short, we realized that there are different investment approaches out there, and that it is very important for us to be clear and to keep in mind which method we are using, so that we don't confuse ourselves. And of course, we know that since there are multiple ways to invest, multiple strategies, it is always good to diversify and spread the 100% of our portfolios among these different strategies and methods. Okay. And we also realize as well that when we take a step back and look at our investments from a holistic point of view, if our quant investment approach is aiming for stable and reduced volatility, while keeping returns decently satisfactory, we can always use it to form a very core portion of our portfolio. So if we are talking about investing 100,000, maybe the whole 100,000 is one core portion of our bigger portfolio. Or on the other hand, we can very well use, say, 30, 50, 60, 70% of that 100,000, whichever we are comfortable, to run a quant investment strategy. The key is to balance out your risk. And in the second week, we covered on volatility, as a very special asset class, particularly because it has a very low and usually negative correlation with the rest of the general market, making it a very strong and helpful hedging tool to protect our investments against market crisis, and black swan events, which Patrick Ling has already mentioned strongly just now. We also noted that gold and bonds, while they can be very good cushioning tools, the level of effectiveness they have on our portfolios can still be very different from volatility. And therefore, volatility is something that we should really consider utilizing for ourselves. At the same time, we also note that volatility is not something that is too straightforward to implement. We do need to know how to utilize a volatility risk premium, which is the difference between implied and realized volatility. And also we have to be extra careful to potential time sensitivity, as well, not only because some volatility ETFs do have a general downward trend. The asset class by itself also runs a risk of losing a large portion, say 80% of its total value overnight. And because of how mistakes can be so costly, the last thing we want is for investors to try dabbling with volatility without your clear and reliable signals to enter, and also, like Patrick mentioned just now, to exit. Please don't do that, right? If you would like to add volatility to your portfolios, but you have no experience on how to do so, right, please come and look for either myself or AllQuant, right? We would be happy to guide you on how to run this strategy, which is more often than not best also utilized alongside other investment strategies. Okay, apologies, I think I'm also having a little bit of renovation on my side, so please do bear with me. But I don't find that it is too consistent or too loud yet. I hope that it's still okay. Right. So let's move on. Right, we also covered on the all-weather strategies, right, where we went through how the all-weather portfolio effect is in fact simply that valuable stability that is possible for us to achieve in our investments over the long run. And how is this achieved? We do it through the only free lunch in the investment world, which is diversification. Right? When we talk about diversification, right, we learn as well that proper diversification need not compromise our returns. Right? This is actually a common myth among many investors. Right? The truth is, when we diversify properly, we can do just as well or even better in terms of our returns. Right? And the way we do it is to not just diversify across stocks and different asset classes like bonds and commodities, just throwing all of them in, right? Apologies for that. Right? But very importantly, right, we want to also diversify across strategies. Okay, and some of you might recall that we also had a special session, right, where we went deep into the psychology of investors, right, where we concluded that investing is a lifelong journey, right, from which the key to success is actually to develop and practice good habits in our investing, right? Depending on the approach we're using as well, there will be habits that are crucial for us to develop, and therefore as retail investors going about our everyday lives, this is what we truly need to be focusing on while we grow our money, and at the same time we also want to focus on the many other things we want to go about in our everyday lives. Right. And just a week ago, right, we covered on the multi-strategy portfolio, right, which showed us how we can use multiple strategies to maintain some of the most robust and attractive risk-return ratios, right, as well as create some of the most stable double-digit returns that we have seen so far. Right. We touched on the efficient frontier, right, on that day, right, which is basically a curve showing us all the possible portfolios that we can have given a basket of securities, of investment instruments, right? And consequently, it also shows us all the possible risk-return ratios that we can have for ourselves. Right? And what we saw from implementing multiple strategies is that it actually moves that efficient frontier curve upwards, right, and improves all those possible risk-return ratios. And then finally, for our last two sessions, we talked about generating passive income, where we learned that the stability from a multi-strategy approach can potentially allow for regular profit taking off the table, as long as we do it carefully. Right? The key to this is low volatility and low maximum loss in any given year. Right? And just 2 days back on Thursday, we gave everyone a more holistic view, right, on the possible ways to generate passive income, right, letting us all understand that many private trust funds, right, they do utilize quant investing to generate their passive incomes as well, right, while maintaining that growth in their portfolios. Okay. So this was what we've covered during the festival this year, right, and we definitely can give a more detailed summary given the limited time that we have today. But for those of us who would like to go back and review the content we've shared, again, don't worry, because AllQuant, right, has been putting up, right, the recordings, right, and in due time we will be putting up the rest of them as well, right, after we have cleared those videos for security and proprietary requirements. Okay. So for now, let's go into the multi-strategy portfolio. Let's talk a little bit about it, right? The portfolio that AllQuant has previously shared about last week, right? Since we have just recapped on the lessons that we've learned, right? Let's look back at this hedge fund strategy that AllQuant suggests we can implement, right? With the help of iFAST World Markets here also. right? And Patrick and Eng Guan, right, do you guys like to come in, right, and talk a little bit more generally about this multi-strategy portfolio?
Okay, sure, Tawi. Okay, like just what Patrick said earlier on, right? Why we the impetus or motivation for us running a multi-strategy portfolio is because I think there's no single strategy that can kind of cater to all kind of different market states or market environment. All right. So if I were to sum it up very neatly in a sentence that you can take away here today is that there's no such thing as a best strategy out there. Okay. So remember that there is only the right strategy at the right time. Right. So that is why it is important for us to kind of leverage on the advantages and strengths of each of the different strategies out there in order for us to kind of be able to build a robust portfolio that can help you weather different types of market conditions itself. Okay, and this multi-strategy portfolio that we have constructed comprises of 4 different strategies, which includes the all-weather strategy that I talked about in one of the webinar sessions, as well as the volatility strategy that Patrick talks about. Okay, and it has 2 other different strategies out there. Okay, it is constructed primarily, right, using almost entirely, in fact, using ETFs, which are all large and liquid ETFs readily available on the New York Stock Exchange. So there's less of an issue in terms of you trying to kind of buy and sell, right? Unlike if you, let's say, you were to buy or invest into illiquid securities like micro caps, small caps, right? That you will have no issue trying to place trades or implement or execute them and getting a good price off the market with all these ETFs here. And the thing of how this thing works is that it is diversified, as you can see from here. I don't know if you recognize the tickers and all that is diversified across different asset classes. So you'll find there are stocks, there are bonds inside there, a good component of bonds as well. And you also find commodities like gold, real estate, right, as well as volatility as an asset class, right? So all these 4 different strategies kind of interplay and kind of work in complement of each other and try to help each other weather through the different markets itself. Okay, we don't have a net asset value line chart here, but I think we've shown that in previous webinars. We actually run this model through 2005 all the way up to now. So they've seen through various different crises like the great financial crisis from 08 to 09. It has seen through the 2015, 2016 sell-off, right? Due to some problem brewing in the China market, right? Then he has gone through the 2016 Trump election, the 2018 February Warmageddon, which Patrick mentioned earlier, as well as the US trade war, right, between US and China, which lead the market to undergo a steep sell-off in the last quarter of 2018. And fast forward to the most recent one, is also been through the COVID-19 pandemic, which has happened last year, but across just 2 short months. I think we've seen the shortest bear markets, 2 months, right? It's beating record every single time you see it. So the next bear market that comes along, I don't know, maybe in terms of weeks, all right? Just a possibility here. But overall, right, through all this crisis, the portfolio managed to emerge out of it well. Yes, at times it may lag the stock market, not when you see the stock market flying like, wow, giving you 30%, 40%, that kind of returns. This portfolio is still charging on, giving you like maybe 10 over, at most 20 over %. But this 10, 20 over % is a very stable 10 over 20%, because when the crisis comes along, well, this portfolio is still going to perform a lot more stable than the stock market itself. All right. So when the portfolio actually crashes, when the stock portfolio actually crashes like 50, 60%, but this portfolio actually manages to weather through the same crisis, going down only like maybe 12, 11%, right? So there's a lot of stability in terms of it being involved. And that this stability is important, let's say, if you want to kind of like generate passive income from it, right? Because if portfolio is a lot more volatile than what it should be, and imagine when you need to draw the money out, it undergoes a 50, 60% drawdown. And every single cent that you're going to draw down from the capital of this portfolio, right, is going to prevent your portfolio from recovering even more, right? So that's where the concept of like managing risk comes in, right, which is actually kind of blended into this portfolio itself. Yeah. Yeah. Okay. I think in general, I hope I give a good sense of what this strategy is about or this portfolio is trying to do. Yeah. If anything, Patrick, you got anything you can add? All right.
I've got nothing to add, but maybe if the audience have any questions, then they can just ask us, then we answer later. Yeah.
Thanks, Eng Guan, and thanks, Patrick, as well. Right. And I must add on, right, and say that this multi-strategy approach, it actually has one of the best risk return or Sharpe ratios that my investment advisory team, we have personally seen as investment advisors. Right? If any of us do look through a lot of portfolios run by retail investors, right, we would often find that a lot of Sharpe ratios, right, are nearer to the range of somewhere around 0.3 to 0.8. Right? And even some of the best unit trusts, right, actively managed funds, right, mutual funds out there that I even personally utilize for investing through fundamentals, right, they have the best Sharpe ratios close to around 1.1, right? And for this portfolio, could you share with us what is the Sharpe ratio again for this portfolio, at least the latest number that we're seeing?
Sorry, Tao, you're asking us, is it? So
yeah.
As of the last closing day and over the simulation period, the Sharpe ratio is 1.27.
Thanks. Right. So yes, for this to be at 1.27, it really stands out, right? So if any of us, right, you are keen to run a portfolio, please feel free, right, to click the URL. I think Eng Guan or Patrick, maybe you can share the URL, right, to your website, right, so that those who are keen on exploring on this strategy, they can actually just click that URL through our Zoom chat section below, right? And we are actually expecting just about 1 to 2 trade actions monthly. And all you have to do is to give your email approval once a month, and the strategy can run very smoothly from there. Okay. So for now, let's move on, right, to our third section today. Let's go into the students' challenge, right? And to come and understand more about how we can invest 100,000, right? And today we have students from, as mentioned just now, the SUSS Singapore University of Social Sciences Investment Group, right, who have a short video for us to showcase their work in suggesting how we can invest 100,000, right? And due to their other commitments, we still have their whole team with us today, but we may not have some of them for the whole of the duration, right? But nevertheless, I think we still have with us here Izzuddin, right, Edith, Xie Li, Wei Sheng, and Yong Chang with us, right? My dear guys, right? You can now turn on your videos, please, right, so that we can see you. And is Izzuddin around? Hi.
Yeah, hello. Are you guys able to hear me?
Yes, Izzuddin. We are still not able to see you. Are you able to turn on your video?
Hi, are you guys able to hear me?
Yes, Izzuddin, we can hear you. Are you able to turn on your video? Okay. Yeah. Wonderful, right? I can see you now. Okay, so Izzuddin is the team leader for this team from SUSS. Right, maybe Izzuddin, you want to introduce your team and also talk about your CCA to every one of us?
Yeah, sure. Before we start, my teammate Edith will actually be presenting our CCA before we move on to the presenting our student challenge. So I think Edith can take the time to present our CCA. Thank you, Edith.
Okay, sure. Sorry, can I share screen?
Yeah, sure.
Okay, so hello, good afternoon, everyone. I'm Edith, the Vice President of Strategic Development of SUSS Investment Group. So before we share our presentation on the case study, I would like to give a short intro to SUSS Invest. So SUSS Invest was founded in 2017, and we are a student-led platform that aims to impart financial and investment knowledge and also provide professional development opportunities. So besides the weekly global macro and equity research sessions that we conduct, we've also been looking to create new opportunities for learning and networking. We have conducted financial modeling workshops in our inaugural presentation day, and we're also currently crafting an intervarsity portfolio management challenge, which will commence at the end of the year. So interested participants may keep a lookout on competition details on our Instagram. So over the past,
do you mind trying to stop share and reshare again, because we are not able to see your screen actually?
Oh, okay.
Thanks everyone for your understanding over some of our technical issues. Yes, we can see your screen now. Wonderful. Right, please continue.
Okay. Apologies on that. Okay, so over the past few years, we have also been actively participating in external events such as CFA Ethics and the Research Challenge, where we actually emerge as national finalists. So you guys may feel free to check out our Instagram at SPSS Invest to find out more about us. So right now, we'll present our insights on Mr. Lim's case.
Thank you, Edith. Right. So let's come and see what our students have in store for us in their proposal on how we can invest 100,000. Okay, so let me bring up. Okay, so please go ahead and play the video, Edith. It is the volume is a little bit soft, but maybe let me play the video on my end so that every one of us we can hear clearly.
Sorry.
Edith, the volume is a little bit low, right? Let me just play this from my end so that we all hear very clearly, okay?
Hi, Ran. Before I start, I would like to thank iFAST and AllQuant for inviting our CCA to present in this investing festival. So let me just introduce the team. My name is Izzuddin, and I'm currently the Vice President of the Equity Research Department. And together with me, I have Edith, Yongchang, Kendrick, and Wei Sheng, who will be presenting the Portfolio Management Challenge. So moving on, let me just introduce the portfolio summary. So for our portfolio, we actually adopted a strategic asset allocation, and we focus mainly on 4 industries, and we only adopted equities within our portfolio. So the 4 industries that we actually focus our portfolio on will be the healthcare industry, which makes up 55% of the entire portfolio, followed by technology, materials, and industrial, all of which take up 15% of the entire portfolio. So we actually also have a constraint of at least 5% for every ETF that is within the portfolio itself, and a maximum of 30% for every ETF that is within the portfolio. So in terms of its performance, we can actually observe that the portfolio returns have actually seen a return of 25.7% over the past 5 years, with a standard deviation of 22.4%, which gives us a sharp ratio of 1.15. So based on our client portfolio, we actually propose a diversified portfolio across various industries and regions using ETFs, as mentioned, and we adopted a qualitative and quantitative approach when selecting the assets to be added into the portfolio and the weightage. And the portfolio will not require as much time and energy to run. So let me just pass the time to Wei Sheng, who will be talking about the materials industry.
Yes, thank you. So I'll briefly be touching on the materials industry. So what we have here is a chart for the PPI for building material and suppliers value. So you can see that for the month of 2020, it's actually remaining quite constant, which is a reflection of the level of strength that the materials industry has. And going by the global chemical shipments value chart on the right itself, we see that Asia Pacific makes up a significant portion of the global chemical shipment, which is followed by countries like Europe, North America, Latin America, Africa, and Middle East, as well as the former Soviet Union. So what are some of the key drivers that will drive performance within the materials industry? Firstly, the building up of supply chain resilience by companies within the materials and the chemicals industry amid COVID-19 pandemic supply chain shocks. Next will be the development and establishment of ESG trends in the chemical sector, which is then followed by Biden's American Jobs Plan aimed at creating demand for materials to support infrastructure projects within the US. And of course, the usage of renewable energy infrastructure within the mining industry, So these factors taken into consideration actually brings about a somewhat positive it brings about a positive outlook on the materials industry, as these factors are believed to show up demand for the materials industry for a while, as it's as it's an essential component of our industry as well. The next slide. So I'll now be handing over the time to our next presenter.
The next sector I'll be talking about is the industrial sector, which has 14 industries within the sector. Looking at the industrial production index on the left, which is a measure of the output of the US industrial sector, has been in an uptrend since February this year. On the right, we look at global manufacturing PMI and global industrial production over a 15-year time period. Global manufacturing sentiment gauges are pointing towards some of the strongest growth rates in industrial production in the last 15 years. We have identified 4 key drivers for the growth of the industrial sector. Firstly, with the growth of big data and the rise of new and connected technologies, from artificial intelligence and machine learning to robotics and the Internet of Things, firms in the industry can harness on the latest data and digital techniques to improve processes and supply chain efficiency to meet customer needs. Secondly, with the large fiscal spending such as the 1.2 trillion infrastructure bills, which includes building new roads, bridges, and investments towards clean energy and upgrading power infrastructure, will help to stimulate the industrial sector. Thirdly, with strong global trade and increase in e-commerce activities, the demand for services from the industrial sector is higher than ever, thereby driving the sector's growth. Lastly, with COVID-19 shifting from a pandemic to an endemic, the sector is likely to see an increase in demand for services. The pandemic affected manufacturing and supply chains due to social distancing measures, as well as reduced air travel demand. With several developed economies such as UK and US achieving high vaccination rate and return to norm, industries such as airlines, which were previously heavily affected, will likely see a rise in demand and thereby drive growth within the sector. Moving on, Edith will be sharing more about the healthcare sector.
The first key driver we look into for the healthcare industry is the growth of venture funding for digital healthcare companies focusing on telemedicine, wellness, and analytics, where telemedicine and teleconsultations have been great alternatives for healthcare since the start of the pandemic. As shown in the graph on the left, the funding for digital healthcare firms has increased 138% from the first half of 2020 to the first half of 2021. Also, we see in recent years that there has been new research and innovations in cancer immunotherapy and robotics to assist in complex procedures. Another key driver is the increasing global aging population, which identifies an increasing fundamental need for preventive healthcare. In addition, the rising global middle class income population increased from 899 million in 2011 to 1.34 billion in 2019, indicating a possible increase in demand for preventive healthcare products such as insurance. Therefore, we expect to see growth in the healthcare industry. Next, Kendrick will be sharing about the infotech industry.
For the IT industry, we believe that the 4 key drivers that will drive the tech industry to a greater height will be: firstly, the COVID-19 pandemic has pointed that moving forward, technology will be significantly important, and digital transformation cannot be purchased overnight. Hence, it is an ongoing process where this would create a tailwind to accelerate organization digital transformation efforts that will boost the tech industry. Secondly, since technology can be found anywhere and is a pretty common theme in almost all organizations, rising competition pressures are placing a premium on speed, agility, and flexibility, with an emphasis on advanced technologies such as boosting automation, which can be achieved from the artificial intelligence industry, enable real-time operations from the 5G development, and also organizations can reimagine its business model through a move to cloud system and critical capabilities in areas of big data and edge computing. Hence driving organizations to rapidly adopt to stay competitive. Thirdly, the tech industry is moving at a rapid pace, with tech competitors trying to develop something that are never seen before, pushing boundaries in creating enhanced capabilities to maximize the values added to their vendors. Hence, it is also an iterative process where organizations must constantly revisit or pursue new fine-tuning of their digital strategies. Lastly, for many companies, the impetus to move to cloud has promise of enhanced flexibility, optimizations of business process, and reduction of costs where it can improve organization expense model or enhance the scalability of new applications and infrastructures. Hence, there's an increased demand for data center infrastructure to cope with the pent-up or rising demand. Next up, there's a new trend emerging where organizations are adopting remote working. Even up till now, many are working remotely from home. And there is a potential where advanced economies such as UK, US, China, where employees are working through a computer, thus having no need to work from the office. Furthermore, benefits from remote working drives productivity and flexibility. It was also reported that workforce could dedicate 28 to 30% of the time to work remotely without losing any productivity. COVID-19 has enabled many to realize the positive impact technology brings to our life, as well as the positive impact to the company. Therefore, there will be an emphasis on tech development, as it will bring about many benefits such as decreased costs, increased revenue margin, and overall, just improve on the company's business model. Hence, this acceleration leads to focus on different segments in the industry. COVID-19 pandemic has damaged many sectors and businesses where they suffer from revenue decline. However, if you were to observe the cloud service spending and AI tech spending, they're actually increasing at a 15.4% and 7.4% CAGR respectively. This has proven its resilience and scalable model through times of uncertainty, where it emphasized the need of this tech in today's tech-driven era. The cloud sector has also become the foundation and a must-have tech to propel organizations to upcoming technologies that will prove to disrupt the market. All of these technologies have become a necessity for organizations to accelerate on their digital transformation efforts, and also a part of the benefit this technology industry services will enable organizations to see a decrease in operational costs by up to 30%. I will pass my time to East.
Okay, thank you, Kendrick. So we'll just look at the performance of the respective industries in terms of their stock prices. So as we can see from the graph, we can actually observe that the tech industry leads the performance in terms of returns with a annualized returns of 33% from 2016 to 2020. And this is followed by materials, which saw a annualized return of 18.2%, followed by industrial and healthcare. Similarly, the ranking of the volatility is also of the same order, leading the way with the tech industry with an annual volatility of 23.3%, followed by materials with 22.5%, and followed by industrial and healthcare. So with the returns and volatility, we can observe that tech industry had the highest Sharpe ratio. So bringing our focus to the correlation metrics and the covariance metrics, we can actually observe that the highest correlation and covariance occurred between the healthcare industry and the materials industry, and the highest correlation between industries happened between materials industry as well as the industrial industry. So that summarizes the performance and of the respective industries. So let's move on to the portfolio. So based on our computation, we actually adopted a minimum level of standard deviation to determine our weightage of the ETFs within the portfolio. So as mentioned earlier, at the start, we actually put in 55% of the entire portfolio into healthcare, followed by tech, material, and industrial, each of them carrying a weightage of 15%. And the portfolio performance of it actually saw a return of 25.7% over the past 5 years, with a standard deviation of 22.4%, giving a Sharpe ratio of 1.15. So that summarizes our presentation. Thank you.
Thank you, our students, for that wonderful sharing. But give me a short moment while I bring up the slide. Okay, over here. Right, so thank you to you guys, right, for all that hard work, right? And we can see that your team certainly put in a lot of effort, right? Especially at the parts where I saw how you guys use your strengths in fundamental analysis, right, to find key drivers in market sectors. and also mixing these together to even give an iterative approach to your portfolio over time. But I even saw the covariance matrix. But personally, I'm very impressed to see how you guys have learned about quant approaches, right? And also how you guys have grown in just these short few months learning from AllQuant. Right? Wonderful, wonderful work. Right? Patrick and Eng Guan, can we have your views as well, comments, questions, alongside also about your mentees' work?
Okay, I'll just give a very quick one. I think overall, very nice and great effort that you have put in. Again, like the NTO team last week, right? I think the presentation is visually very appealing and professionally done. And I think you all make use of a good blend of ETFs here. And I see that even within the same sector, you all have kind of diversified it across different issuers, right, of the same sectors, right? So then, and it's also good to see you all apply or make use, right, of some quantitative concept in terms of trying to do up the allocations to your strategic asset mix, right? When I say I see you all apply the minimum variance concept to come up with that. So that is very good, right? And definitely with the sector analysis in terms of the views. So personally, I'm not that much of a view person, right? I mean, we have spoken on this before, so I won't comment on that, but I can see a lot of effort being done into all this different sector analysis itself. Okay, so maybe a bit of suggestions on my part, like how you can actually do this better. For example, you focus on 4 sectors, right? So there were still another 7, 8 sectors that were actually not included as part and parcel of this portfolio. So although I can see that you guys are thinking that the growth drivers are primarily in these 4 sectors, that's why you put it in as the portfolio. But I think it would be good on the side to share why the other sectors are actually not included in as well. For example, the staples, discretionary, your telecoms and all that. Okay, and as with all market views, so you have a view coming forth. So I think it's good to put a timestamp or time frame to how valid you think this market view is going to last. Is it going to be what you expect for the next 1 year, 2 years, or 3 years coming down the road? And maybe to highlight what are the kind of risks that can possibly derail, right, that thing which you think is going to happen from happening itself. Okay, and the last point is about the back test. I think 25% is an impressive returns, definitely. I think a lot of people will be attracted by it, and the risk within that 5-year period is also low, so it gives you a good, fairly efficient Sharpe ratio 1.1, which I would say is impressive. Okay, but you got to recognize that also from the part of the last 5 years, it's actually one of the strongest bull market in history. So if you use S&P 500, the returns won't be that high, but the Sharpe ratio also fairly high during this period. So for a pure stock-based portfolio, right? So the real litmus test, right, is not so much in a bull market. So to see the full range of risks that can actually happen to such a portfolio, then you may need to kind of stretch your back test a bit more back way earlier, right, to cover, let's say, the great financial crisis or even the .com, right, bubble. Well, that would be like kind of even more fantastic. So if there's a lack of data, then you can maybe make use of like the indices instead of the actual ETF, indices as a proxy, right, for the sector performance. Then you will see during the .com, how will such a portfolio actually perform, right? And during a great financial crisis, what will be the performance, right, you can expect. But then the full range of risk without the different market cycles will be clearly presented. Yeah. Yep. Okay. So that's basically from me, but great job, guys. Right. Well done.
Okay, we're running out of time, so I'll just make it a quick one. So generally good effort across the board. Just one comment, and that is, so the Sharpe ratio that you guys have come up with, right, is based on the historical period of 5 years. So obviously I mean, it's moving forward. I don't think we can expect to see the kind of static kind of Sharpe ratio for the portfolio. So maybe one suggestion is that maybe you guys can explore looking at a way in which to instead of using just simply using a historical window period to fix the allocation, right? How can you come up with a dynamic allocation approach that actually allows the allocation to shift around and still try to maintain a sufficiently high enough Sharpe ratio? So I think this is something that is a bit more advanced, and obviously I don't expect you guys to know it at this moment in time, but going forward is something for you to look at. Yeah, that's all. Thanks.
Thanks, Patrick and Eng Guan. right? And also thank you to our students from SUSS for that great video sharing. For compliance purposes, I do need to just quickly mention that the information shared by our students, right, they are purely meant for education purposes only, and they do not constitute the views of iFAST or AllQuant, right? But nevertheless, right, really great effort across the board, right? And we can certainly see how you guys have grown, right, in your investment expertise and knowledge, right, and how you guys carry about that daily considerations, right, in your investments. And as part of our CSR efforts, iFAST Global Markets is very happy to see that growth and maturity in our young people coming through our engagements with them. Right? It is so important for us to be giving back and to help groom our next generation of investors for the future. So well done, right? And thank you to you guys. Right? And speaking of giving back, like to end of the festival, it is now time to also give back to our festival participants, right? You guys, for all of your support in attending our sessions and taking part in our quizzes, right, through our lucky draw. Okay, so our first, second, third place winners, you'll be getting AllQuant's course packages, right? And also first and second prize winners, CapitaLand vouchers. Third prize winner, there is a very cute iFAST plushie soft toy for you, right? It's a very nice, I think it's an ox or a bull, right? So that's a very nice token of appreciation to you as well, right? So let's come and review our winners, right? I will be doing a live drawing, right, through an Excel, right, so that everyone can see actually who are the winners. Okay, so give me a moment while I set this up. Okay, so over here. All right, so we have over here, I'm going to draw who, I'm going to do a drawing, right, on the last 4 characters of the NRICs, right, that we have received, right, through our quizzes. Right? And what's going to happen here is that the first winner will be shown over here. We're going to start with the third prize winner. Okay, so I'm now going to press F9 to draw, right, and the answer is still in the same color as this cell over here, so you can't see it, but once I change that font color, everyone will be able to see who's the winner. Okay, so here goes. Right, our third prize winner, right, I'm going to press F9, and our winner is, congratulations, right? If you have your last 4 characters of your NRIC as 622P, congratulations, you are our winner for the third prize. Okay, so you're getting an AllQuant style course package, right? It is worth 577, right? Do note that the numbers over here, I think we last mentioned that actually this is your cost price, right? This is how much you guys actually have to put in, right, to come up with this course package itself, right? And it is worth $100 over for the third prize, right? And as well as the iFAST plushie as well. So congratulations to you, right? Now let's move on to our second winner, right? Second prize, right? I'm going to just press F9 again, right? And we will see who is the winner. Okay, so let's begin, right? 3, 2, 1, right? Okay, so if you have 951G as the last 4 characters of the NRIC, congratulations, right? You are our second prize winner. Okay, and you will be getting CapitaLand vouchers as well, $50 of it, right? And more importantly, right, you will be getting $1,000 worth of AllQuant's intermediate course package, right? Congratulations to you. And now let's proceed on to our first prize winner. Okay, so drum rolls, everyone. Right, and 3, 2, 1. I'm going to reveal now. The first prize winner is 468I. Okay, if you have your last 4 characters for NRIC as 468I, congratulations. Right, this is the AllQuant mega course package worth $1,652 to you, right? You are going to find a lot of AllQuant's courses, right? And you're going to be able to learn many of their strategies, right? And also, as a small token, $100 worth of CapitaLand vouchers will be given to you as well. Okay, so for the winners of our lucky draw, right, we will be trying to contact you through email, right? And please revert back to us, right, on the procedure ahead that we will be sending to you, right? And so congratulations to the three of you, right? And really, really happy to have everyone here, all of you guys joining us so far for the past 3 weeks. It has been a wonderful 3 weeks, right? And we sincerely hope that, on behalf of all the organizers, we sincerely hope that you have taken away at least something, right, to learn about investing, right, to learn about how you can grow wealth, how you can accumulate your wealth over time, right, and to also understand more about quantitative investing, right. So if any of you guys have any questions, right, we are overrunning by quite a bit, right, but if you guys have any questions, please feel free to stay on, right, and you can just put your questions into the Q&A section box below, right. We will be still leaving this session on so that we can collate all your questions, right, and we will answer them by reverting to you through your email that you have used to register for this Zoom session. Okay, so just a disclaimer over here, right, and that's all, right. Thank you for joining us, right? And we really wish a wonderful, wonderful weekend and a future of investing ahead for all of you guys as well, right? Thank you, right, and have a great, great year ahead.